Everybody, and welcome to our broadcast today. My name is Steve Weibel, and I want to thank you for joining in. Today, we're going to talk about which business entity is best for you. Now, look, when launching a business, there are a million and one things for you to do: raise money, hire staff, develop a marketing strategy. The list tends to go on and on. Choosing among the types of business entities is probably not at the very top of your list, but it really should be. The decision has real legal and financial implications. The amount of taxes you have to pay depends on what you choose from the type of business entities, as does the ease of which you can get a small business loan. So let's dive into it. Like I said, my name is Steve Weibel. I work at Credit Suite. I'm a presenter here. I've also built and sold multiple companies, everything from the printing industry up to real estate investing. So I've done this a couple of times, and I've chosen different entities each time for different reasons. So speaking of, what is a business entity? And I apologize in advance, guys. I pulled my neck. They put me on prednisone, so I may be talking way too fast. So if I am, I apologize. Just play this in slow-mo. So what is a business entity? A business entity is a commercial, corporate, and or other institution that is formed and administered per commercial law in order to engage in business activities, usually for the sale of a product and or service. Essentially, an entity is what allows the company the ability by law to conduct business. Now, different types of business entities, they really should be chosen with care. The decision you make will have real present and future consequences. And each type of business entity that we dive in today, we're going to talk about the pros and cons of each entity. When you're setting up your business, not only does it the type of entity you choose have consequences, but also can provide benefits. Everything from tax benefits to being able to apply for a loan and get that loan. They can even save you money if you choose properly. Now, let's talk about why not every business entity will do. Each business has its own separate function, and each business entity will have its own separate positives and negatives. And we're going to go into that. Your business entity matters because it has to do with real money. And I'm talking about real cash in both the present and the future. The type of entity that you choose will directly affect the amount of taxes you're going to pay, who has control over your business, whether you can be sued or not. These are the things that we're going to dive into today. They're going to make a real difference. You obviously want to keep more of yours, right? So let's talk about how we can get you to do that. Now, we talk about the different types of business entities. The IRS recognizes the following entities: a sole proprietorship, a partnership, a corporation, or what you'll hear other people say, a C corporation, and there's also an S corporation. An LLC is not considered an actual separate entity by the IRS. When you choose an LLC, you have to choose what type of corporation you're going to be. In my case, my LLC was always an S corp, or it functioned as an S corporation. So let's talk about the taxes. Sole proprietors are the same as their owners. Basically, this is the most popular version of a business entity. You have an idea, you have customers, or you have an idea where to get your customers, and you just want to open your business. You can open a sole proprietorship. Now, when you open a sole proprietorship, you are not required to file anything. There is no registration with the Secretary of State. There's nothing you really need to do other than conduct business and then file your tax return at the end of the year with I believe it's a Schedule C profit or loss. So as a sole proprietorship, you really don't have to do anything other than go out and start conducting business the way you would. Partnerships does not have to pay income tax. Instead, the business will pass through its profits or losses straight to the partners. Now, there are different types of partnerships, so in that case, there may be a slight difference, and we'll go into that. Then the partners will include their respective shares of partnership's income or loss on their personal tax returns. Now, corporations, this is my favorite. Corporations, they do have to pay state and federal taxes as an entity. They are a separate entity. They sometimes also pay local taxes. This will include paying income taxes on profits. Now, it's taxed at a different rate than an individual is. The exact opposite of partnerships and sole proprietorship. So in other words, the corporation will make a profit and it will pay income tax on that profit. Then it can choose whether or not it wants to give dividends to the shareholders. And we'll go into that a little bit. The problem is you can end up paying twice if you do the dividend route. An S corporation, only the wages of any S corporation shareholder who is also an employee will be subject to employment tax. This is why I chose S corp. Any remaining income is payment to the owners as a distribution, what we call K1 distribution. And distributions are taxed at a much lower rate, if at all. This is my favorite style of a business. However, there, again, everything has different legal and financial ramifications. You're going to want to do your research into that. An LLC is not a separate entity, according to the IRS, so it isn't really taxed. Instead, its members pay individual taxes. Members of an LLC pay an employment tax on the entire net income of their business. So if you have an LLC and you have a member, a partner, albeit a junior partner, whatever profit that LLC makes, it'll be passed through right to you, just like a sole proprietorship and or a partnership, and you'll pay individual taxes based on that. Now, if you want more information, go to creditsuite.com/EIN. You'll see that on our slides. Let's kind of dive into the legal liability. And this is where it really becomes important as to what type of entity you choose. And a lot of it's going to be based on the type of business you're in. With a sole proprietorship, there are no limits at all to your liability. You are the business and the business is you. It's one and the same. So it has great advantages in that there's less paperwork or no paperwork that you have to file to start a sole proprietorship, and you truly are in business. You run the entire thing. Everything flows through you. The disadvantage is that because you are the business, you are liable for all debts and obligations and any risks from actions of employees. So let's say you had a printing company like what I had, and you kept it as a sole proprietorship, and one of your employees did something wrong. You are responsible for any lawsuits that may come pending for what that employee did. So that's the danger of a sole proprietorship. It truly is all your responsibility. Partnership retain full share liability as well. Therefore, partners not only liable for their own actions, but they're also liable for business debts and decisions made by their other partners. Now, there are different types of partnerships, and we can get into that a little further. There's limited liability partnerships, which is similar to this, but in reality, when you have a partnership, you are liable for everything that your partner does. Typically, a partner's personal assets can be seized to satisfy any of the other partnership's debt. Now, when we talk about corporations, it changes the liability level a little different. Within a corporation, the shareholders' personal assets are completely protected. Now, there are some cases where they can pierce that corporate veil if there's been fraud committed, typically, or a felony. Shareholders can usually be held accountable for their investment in the stock of the company, or can only be held accountable for their investment in the stock of the company. However, if an employee commits, like we talked about, fraud or a felony under the corporation's direction, by the way, the corporate veil can be pierced and personal assets could be on the line. The obvious solution to this is don't tell your employees to commit fraud or felonies. This is where you're going to find the most protection. An S corporation, shareholders' personal assets like personal bank accounts cannot be seized for the purpose of satisfying any business liabilities like verdicts against the company. So if you have an S corporation, which is what I have my properties in, if someone fell down the steps and sued, they can sue the corporation and any assets that the corporation had, but they could not come after me personally. Now, obviously, I had insurance on these properties to make sure that if something like that happened, I was protected. I wanted to protect the corporation as well, but I knew that I personally had no legal liability as long as I didn't commit fraud. LLC members are also protected from personal liability in a limited way. The LLC incurs debt or is sued, the member's personal assets are usually exempt, but not always, hence the term limited liability. I know most people go for the limited liability because it's easy to file. And certainly I wouldn't suggest against or for that, but you have to look at what the potential liability is down the road, future for your business, including tax liability. Now, we talk about costs and shares. Let's talk about the costs. Sole props, the owner is the company. If it makes money, then so does the owner. Their share is basically 100% of the company. Partnerships, shares vary, and they should be clearly spelled out in the partnership agreement. If the shares are not specified, they are assumed to be equal. Now, there are different types of partnerships. There's partnerships where you have two owners both heavily involved in the company, and let's say they're 50-50 shares. That's a true partnership. There's also limited liability partnerships, and you'll see this with doctors and lawyers, where you can actually go out, generate investment, and the people who invest in that limited liability partnership are not responsible for any actions of the partnership. They're just investing money with what we call, I'm sure you've heard this term in the past, silent partners. So if you have a limited liability partnership, it limits the liability of those silent partners because they're not operating in an operational capacity within the partnership. An LLC is also another type of corporation, and the only real difference is in liability is rather than shares and cost, it works like other corporations. Now, C corporation. Corporation is run by its board of directors. This is where it gets a little costly for people to start a C corp. These people usually are the owners. Ownership stakes are defined by what percentage of stock everyone owns. If one person is controlling interest over 50% of stock, then their decisions will generally overrule everyone else's. If shareholders have smaller stakes in the corporation, sometimes shareholders will band together to influence decisions or even eject board members when you have board of directors elections. Profits are generally distributed per share percentages, although board members can also take a salary. With my printing company I had set up as an S Corp, we actually had a board of directors. We did that on purpose because I owned 50% of the shares and my partner owned 50% of the shares. And we knew if we had an argument, we could always go to our board of directors, of which there were 5, and they would make the decision. And we had in our agreement that if we did not agree, we presented to the board's decision was final. Worked out really well. So that's something to keep in mind if you decide you want a partnership, but you don't want to have that 50-50 tie, because how it generally works, when you have a 50-50 tie, the one who says no wins. Because in other words, if you're doing X and one partner wants to change and go Y and you want to do X, you win, because there could be no change without a tiebreaker. All right. In S corporation, the shareholder working for the company must pay him or herself reasonable compensation. The shareholder has to get fair market value, or the IRS may reclassify any additional corporate earnings as wages. This is important. If you start an S corporation and you just want to pay that lower tax rate, that 15% as opposed to the 24, 28%, if you don't take a reasonable salary throughout the year and only take K-1 distributions, the IRS will come in and reclassify some of that K-1 distribution as personal income and taxed at a much higher rate. So when setting up your business as an S Corp, which is a great advantage from a tax point of view, you're going to want to talk to your accountant based at the end of the year on the numbers you did and the profit you made, what would have been a reasonable salary for you to take. What you can do is you can write a check to yourself with only the taxes being taken out, and then turn the check back into the company if you don't want to take that much cash out, but at least you paid your share of the self-employment tax, one that goes along with it. So keep that in mind if you're an S corporation. So when is a sole proprietorship best? Let's go through each one of these and talk about the advantages of each one. Obviously, like we talked about, sole prop does it all. They are the business, and this could be really exciting, but also exhausting. I mean, you are literally the chief cook and bottle washer. Some people absolutely love this kind of independence. I kind of fall on that side. I don't like answering to anybody. I'm I'm going to say type A, but certainly super hyper. And you're definitely your own boss when you have a sole prop. You're really not answering to anyone. The problem is you are doing all the work, so you get no help. So when is the sole prop best? Obviously, solos make all their business decisions, but they can always ask for advice from experts or mentors, which I would suggest for every business owner. But the risks are super high because the company is sued. So are they. The rewards are also high because they don't share the profits with anyone. There is no board of directors. There is no shareholders. You make $10,000, it's your $10,000. All right. So let's talk about partnerships. When is a partnership best? Partners do share the spoils and the responsibility equally, depending on the percentage of the partner. The size of the shares dictates how much they actually have. Silent partners generally just want to throw in their money, take out their profits, not much else. That's that limited liability partnership I was talking about. Now, in some states, and you have to check with your state, the state Secretary of State will only allow certain types of business registered as LLPs. Typically, they're going to be doctors, lawyers, accountants, professional organizations where they'll allow that. So just if you decide you want to go the limited liability partnership route, you want to check with your state and see if that's available to you and your business. What I like about the LLP is you can raise money have silent partners. They have no say in the business. So you technically, you could have 30 partners. You're the only one working in the business. You still control the business. You just got to make sure you show a profit and they get a return on their investment, because that's all they're really looking for. So when is a partnership best? They carry a measure of risk, and they are responsible for their own and other partners' doing. So there's the downside there. It's imperative that partners be trustworthy and responsible with each other. They also need a plan in the event one of them dies. We used to have my partner and I had a buy-sell agreement with insurance policy attached to it. That way, God forbid, something happened to him or something happened to me, the insurance company would kick in, and the other partner will be able to buy the shares from whoever our survivors were. In my case, would be my spouse. So my partner with our $1 million policy would have been able to buy my wife out for the $1 million because she would have inherited my shares. So we recommend, or I recommend, if you're going to have a partnership, always have a buy-sell agreement, or obviously life insurance, what they call key man life insurance set up. So in case somebody passes away, you don't have all of a sudden a stranger being your partner trying to run your business. Okay, so when is a corporation best? Like I said in the beginning, I kind of like the C Corp. They have particularly much lower risk to the ownership. The profits go on the business tax returns and not the owners, which can be good and bad. Corporations are completely independent entities. They literally operate like they are a person. So they could be held liable in court for any negligence. However, you're not personally, unless obviously we talked about somebody committing fraud. I like this, especially if you're in a high-risk business like real estate or manufacturing, something you're manufacturing. Anywhere where there's a chance that you could be sued, you're going to want to be a C corporation. If there's a higher than normal risk for that, you're going to want to be a C corp. And then there's also the tax implications as well. So that's something you're going to want to talk to your attorney and your accountant about, but at least understand what a C corp really is. All right. So the number of shares will dictate how much power an owner has. And I'm sure you guys have seen enough movies, you know exactly what I'm talking about. If you have over 50% of the shares, you're not invincible, but you're pretty close. The board of directors will have a little power, but when you have over 50% of the shares, you're pretty solid. Smaller shareholders tend to band together to become a voting bloc, especially in larger corporations, and they influence the company's directions better than if they just acted alone. So let's say Microsoft. If you were a large shareholder in Microsoft, but you didn't have enough power to change the board of directors and you didn't like the direction of the company, you would get together with other large shareholders and put your votes together as a voting bloc so that you had enough power to really dictate what happens at the board of director level, which obviously trickles down through the company. So that's where a C corporation is best set up for investors, for outside people who want to buy the stock, don't want to be involved in day-to-day operation. However, they want some measure of control over what the business does. All right. So when is an S Corp best? The S Corp carries a lower risk, which we talked about, but the business profits will be reported on the owner's personal tax returns. However, the owners save on Social Security and Medicare taxes. In other words, you're not paying that self-employment tax, which if anybody on here is in business, they know what I'm talking about. It's that matching Social Security, that matching FICA. So that's why I like an S Corp. If an S Corp is doing $100,000, $150,000 in profit, and you take out a $35,000 or $40,000 salary, which is not unreasonable, it's not too low, certainly not high. So you're taxed at that $40,000 from an income point of view, and then the company makes an additional $90,000. You can take that as a K-1 distribution or as a distribution of the profits, and it's only taxed at the company's tax rate, which is typically 15%. So you can see how you can save a lot of money being an S corporation, especially if you're the sole owner of the S corporation. So keep that in mind. Again, you want to talk to your accountants and or your attorneys. S corporations are protected from personal liability for its business decisions and or actions. So you get kind of, in my opinion, the best of both worlds with an S corporation. You have lower risk, you have lower tax ramifications if you plan it properly, and you're protected from any personal liability for any business decisions or actions. Okay. S corporations are limited to only 100 shareholders, so keep that in mind. Typically, when a company gets really big, and I've seen this, there was a company called Aluminum Shapes in New Jersey that I did a lot of printing for. They actually built the scaffolding around the Statue of Liberty when they rebuilt it. They built they actually manufactured U.S. postal trucks. Basically, they were an aluminum extrusion company. When they got larger and larger, they went from an S to a C corporation because they wanted to issue more shares to the family. It was tightly held, but as the family got bigger, they wanted to issue more shares. So they actually expanded from an S to a C corporation, which you can do. These shareholders have to be individuals or certain trusts and estates. So they have to be an individual, a trust, or an estate. They cannot be a C corporation, or a foreign citizen cannot be a shareholder in an S corporation. The company has to operate domestically. So you can't start a company, an S corporation, decide that you're going to do business only in the Philippines and just have an office here. You're going to have to change what you are. So keep that in mind. Again, talk to your lawyer, talk to your accountant. They'll guide you the right way to set it up. Okay, so when is an S corporation best? The owners will pay taxes only on the money they earn from the business. This is recorded as personal income. The business itself is not taxed, so there is no dual taxation. There's just level of taxation. Again, you have your personal salary, and then you have your distributions. Like I said, I'm a big fan of this. Talk to your accountant, but this is to me a way to pay less in taxes and still earn a very nice living. The business itself is not taxed, and owners of S corporations who are employees pay taxes based only on their compensation. Again, back to that $30,000, $40,000, $50,000 salary, and then if there's any income, it gets passed through to you, depending on the percentage of stock that you own, and it's taxed at a different rate. So that's a big deal when you start getting into the higher income levels. You're earning 100, 150, 200,000. You might be better off earning 75,000 and earn another 75,000 in profit. The IRS would generally have no problem with that, and you're taxed at a much lower rate. So you keep more of your money, which is what we talked about in the beginning. This means they don't pay Social Security or Medicare twice, like owners of unincorporated businesses have to. And there we go. So when is an LLC best? A limited liability company carries a lot lower risks. Very similar to an S corp and a C corporation, but the business profits are reported on personal tax returns. Now, I'm also a real estate agent, and the only way I can set up as a corporation as a real estate agent is as an LLC. They call it a PA down here. Every piece of income that company makes is taxed as personal income to me. So if I make $250,000, I pay personal income tax based on $250,000. Just keep that in mind. Now, what I like about LLCs is that they're great for small companies. They limit your liability, like it says, and you can always upgrade to a different, because an LLC is not really an individual. It's not a corporation. It's not a separate entity. It's actually not even recognized by the IRS. This can result in owners paying high taxes, like we talked about. They can also pay an employment tax on the net income of the business. Again, once you hit 75,000 or some number, accountants will know this, you're capped out at the self-employment tax. But any profit that the company makes, this is the exact opposite of the S corporation, where you can take a small salary and take distributions. This is basically all you're paying taxes on everything, or everybody who's an owner or a member of the LLC. All right, let's go on to the next one. What is an LLC best? An LLC isn't a separate entity per the IRS, like we talked about. Yet the LLC members are protected from personal liability for business decisions or actions. These are great. What I loved them for was housing. When I was buying and flipping houses or buying and holding houses, I would set up an LLC for every 5 homes that I owned. So the homes would be in the LLC name so that I had the protection of, God forbid, something happens. And I never let it get too big because I didn't want it to have too many assets. In other words, if somebody sued, I didn't want them to have access to 300 properties. They only had access to the value of those 5 properties or the equity in those 5 properties. If the LLC goes into debt or is sued, the members' personal assets are usually exempt. They're often used by groups of professionals like doctors, practices, and law firms and real estate investors. So that's something to think about if that's your type of business, or if you have a smaller business and it's not operating at $1 million+ levels, an LLC may work for you. Okay, so recap. Let's talk. business entities do make a difference in taxes, liability, cost, and shares. An LLC doesn't really cost you a whole lot to register. You register with the Secretary of State, and it's pretty low as compared to a C corporation. Sole proprietorships, you have no paperwork whatsoever, no cost to get started. You could literally get off the YouTube today, start your business, and you're on your way. Typically what they do is they have you use your social security number /000 or -000, and that's your sole prop EIN number, typically. So they do really make a big difference in your taxes, your liability, your costs and shares. Choosing the best business entity means considering what will happen if the company's sued. That's a first priority. You definitely, it's something you have to think about. Being comfortable with who is an owner and the ownership structure. Again, sole prop, you're the dictator of that company. Nobody can play with you. It's your business. If you have a partnership now, somebody else is making decisions. An LLC, you can run as a sole prop, but when you start getting into S and C corporations, there's definitely multiple people who are involved in that business in one way or another. And certainly in the C Corp level, you're going to have a board of directors. You're going to have minutes that are going to have to be recorded. There's a lot of paperwork involved with a C corporation. So you have to keep that in mind as well. Deciding how a hands-on owner wants to be really dictates what type of entity you want. Okay, now I think I flew through this in 26 minutes, not too shabby. Again, my name is Steve Liable. I'm at Credit Suite. If you ever have any questions, you can call us at 877-600-2487, or you can email us at info@creditsuite.com. Again, Steve Liable, 877-600-2487, info@creditsuite.com. I hope everybody enjoyed this YouTube live video today. If you want more information, go to info@creditsuite.com, go to our website, creditsuite.com/EIN, and we'll help you in any way we can. Thanks for coming, everybody. I hope you have a great day. Bye-bye.